Hi, everyone, and welcome to this panel on how MiCA will affect decentralized finance and crypto opportunities in the EU and the UK. We've got a great roster of panelists with a mix of legal expertise and deep industry expertise. But before I get going and start the introductions, it's great to start with a bit of a backdrop. So, I mean, over the past year or so, we've seen a large cascade of catastrophic failures in the crypto industry. We've seen Celsius, BlockFi, Genesis, Terra Luna, FTX. All of these firms at some stage in their life cycle actually had commanded a lot of clout, and a lot of people deemed them almost too big to fail. And so we've seen a kind of Lehman Brothers moment in the crypto industry. And these failures perhaps add weight to the argument that regulation is needed for the crypto industry. But before we get going, I'd like to start off with some introductions so we understand who is actually taking part in this panel. Toby, do you want to take 2 or 3 minutes to introduce yourself, and then we'll work our way across the room?
Yeah, no, fantastic. So I'm Toby Lewis, CEO of Novum Insights, which is a research firm in blockchain and crypto. Been in the space around 7 years, and also a couple of years ago sort of made a foray into fund management. So effectively at Novum, we're gathering data and information on lots of crypto and blockchain activity, and investing into that for our fund Metalink Capital. Always interested in new trends and regulation, and such as MiCA, which I think is the topic today, and intrigued at how that will affect DeFi and crypto for good and for bad. I'm sure we'll delve into that in the panel.
Jeff, do you want to go next?
Sure. Thank you for inviting me. My name is Jeff Hancock. I'm a co-founder, CEO of CoinPass.com. We're a UK FCA-registered crypto asset exchange. We serve retail, corporates, institutions, everyone from an individual investor, bricklayer, property investor, up to a law firm or a SaaS pension. We've been in the business about 5 years now. We're about third or fourth company in the UK to gain our FCA license, and we've got some exciting things in the works for the next 12 months, specifically for our kind of corporate investors. So very keen to contribute today and hopefully add some content to the topic at hand.
Manoj, why don't you go next?
Thanks, Jason. Good morning. Just a brief introduction. I'm Manoj Piris. I'm a financial services regulatory lawyer at FIS WorldPay, who are a payment acquirer, providing the entry basically into the ecosystem from fiat into crypto. And my background is very much in payments in the UK and covering the EU as well from a regulatory perspective. So from all things from PSD2 through to the current crypto landscape as well.
Thanks, Manoj. And last but not least, James.
Hi, I'm James. I'm a partner at law firm Gunnar Cook, which is the largest Web3 law firm in the UK and the only major law firm currently accepting payment in crypto. Personally, I've been involved in crypto since advising the first ICO in the UK and recently helped Mauritius FSU write their regulatory framework. I'm assisting 2 or 3 other regulators this year writing their crypto regulatory framework. So very much focused on the regulatory side.
Cheers all. And just a bit about me. So I head up crypto and fintech globally at ID Now, which is an identity verification technology firm. We are specialists in onboarding customers across the EU and beyond, in particular with a strength towards regulated businesses, which is part of the reason why we count some of the world's largest banks and blockchain exchanges and crypto firms among our list of customers. So essentially onboarding users for a range of different regulated industries. So straight on to the panel. We had a bit of an insight into the current state of play for crypto off the back of the recent failures in the industry. But it can't all be doom and gloom, right? I mean, is it the end of crypto as we know it? Is this the start of a new chapter in crypto? Or are we likely to simply fizzle out and see an industry die out? What are your thoughts, Toby?
Yeah, no. Well, I think it's been a great sort of, I guess, a stress test period, or a bit more than a stress test. But so I think it clearly. I think the events of the last year definitely have set back crypto as an industry, but I think the reality with innovation is it just sort of moves on and moves to another permutation. I think there's I guess one of the really interesting things is clear, and it's been said many times before, but groups like FTX and Celsius and Voyager and whichever other pick your failure, most of them were fairly opaque centralized entities with sort of lots of using complex structuring to obfuscate what was really going on. So especially in the case of FTX and Celsius, I think that then led to a crisis of confidence across all of the various different crypto entities. But then what you saw was a lot of the sort of on-chain activity. Clearly, Terra Luna came unstuck, but many of the other, and partly because it just had a very specific reliance on one or two individuals. But a lot of the on-chain creations in DeFi and the like just kept on sort of soldiering on regardless and working as according to the code. I think the reality is even that level because of the way people were using Aave or Compound or whatever it is, a lot at Uniswap, like a lot of the returns that people were making on the yield side were dependent on volume, and as that volume died off, I think there's also a bit of a crisis of confidence in the DeFi side, and just more generally, I guess we'll probably go on to attempts by the centralized exchanges to gain market confidence by things like proof of reserves. I think a lot of these things are very early, and I think we're in a transition phase. But I think we were talking earlier about how I've been building a startup in the ordinal space on the Bitcoin side, and that seems to be the Bitcoin DeFi seems to be going for a big period of innovation at the moment after many years of not much really. So I think you see innovation always flares up. It always over promises and under delivers, but then eventually you get things that you can build on. I think crypto's been a breakneck sort of speed of innovation, but with that comes some bad behaviors and some overconfidence, and so I think we're just in a classic transitional phase. But I think most people actually in the crypto industry kind of feel like it's almost like the bull market is resuming at the moment. So there's a funny, it's always a bit of a funny, weird area.
Gotcha. And Jeff, so I mean, Toby touched on DeFi just there, and of course, there's a lot of activity on DeFi. There's a lot of applications being built on DeFi, but at the same time, some users find it very clunky, difficult to navigate dangerous, it's a scary place. Do you think DeFi is ever going to see mainstream adoption, or are people always going to feel the need of centralized exchanges, such as yours, CoinPass?
I really think it depends on the education level. One thing that's definitely lacking from even a school level to basic finances before we even talk about crypto is confidence in money. Money, in a relationship with money, I think it is as well. I've been turned off even myself as an intermediate, borderline expert in the field. Definitely nothing compared to Toby and some of the other panelists here. But sometimes a gas cost of 20, 30, 40 bucks is like, am I really sure what I'm doing? Having a MetaMask prompt, not understanding all the hex data or what the execution of that contract actually does, can still put you off unless you actually 100% know what you're doing. And a lot of these DeFi platforms now, mainly due to, as Toby put it, the volume on the network and etc., only work in kind of larger clips. If you're trying to do a bit of DeFi activity in the 100, 200 pound kind of region, you will spend an enormous amount of money just to access these kind of platforms. Centralized exchanges can play their part in DeFi by kind of aggregating a lot of those fees and not passing them on to the users. We can put them down as an operational part of business flow, and people can kind of still access those products and access those yields. So I think that centralized exchanges can play a part in DeFi if it's only interacting with the top quality projects, with the top quality contracts, with aggregating some of those gas fees and making it more user friendly. I think now more than ever, with what we're seeing in inflation, in people's disposable income, that traditional stock market investing or investing in one's ISA or SIP or anything have definitely taken a bit of contraction. And crypto at the moment is still on that kind of pointy end of it. I think we've seen possibly not the end of kind of the crazy yields and the crazy kind of returns that a lot of people might be slightly addicted to. But I think, some of the more reasonable ones that might be in the, non-financial advice kind of stuff. But if you see there's a DeFi yield out there that's on a good project, that's got a long-standing product market fit, that's in that kind of 2, 3, 5% range, those aren't unattainable. But sometimes the attainability of those is you have to put quite a lot of capital into it. So I think when we kind of get out of this, let's call it a consolidation phase, it's a bit of contraction, it's a crypto winter, which I think we're starting to teeter on maybe the end of slightly. It's been 18 months. That's kind of what they usually tend to last, 18 to 20 months. As the volumes start to increase and the network traffic increases, and we start seeing, more upgrades to Ethereum and more upgrades to Polygon and etc., that as the gas fees come down and you can invest smaller amounts, we might see people, dollar cost averaging into DeFi platforms instead of just into Bitcoin, into more stablecoin usage, into just a renewed, market confidence. And this stuff happens in cycles. We all went through the ICO phase, we went through the IDO phase, we went through, 2 or 3 big major dips, and this crypto winter is kind of nothing different. We had several black swan events in this particular dip that was different to other ones. But I think we'll all agree over the last 5 to 7 years of market activity, none of these contractions and consolidation periods have been the same. The market's always been different. The economy's always been different. But yet crypto has still survived. And just to echo Toby's point, the businesses that are building on top of it might come and go, but the underlying technology, the blockchain, hasn't skipped a beat. I think the Ethereum 2 upgrade that happened a few months ago, that was the biggest anticlimactic event I remember doing. We did about a month or 2 of planning and prep work and announcements and strategy and making sure our users were fine, making sure our custody was fine. And then the block happened and I was on the treadmill at the gym and I was at it. We're now on proof of stake. So I think, the technology that underwrites all of these businesses and platforms truly has spoken for itself. And I think that alone shows that crypto is going nowhere.
Gotcha.
Jason, sorry, Jason, I'm just going to tie in both the points that were made by Toby and Jeff. I think they're both interlinked because you originally asked about, is crypto effectively dead as a result of the recent past? And I think the answer to that is not necessarily so. If we link both of what Toby and Jeff were saying there, which is that this is a period of consolidation in terms of those who are participating in the market, understanding what their obligations and roles are. So it's a period of education for us as the actual providers of services. And then also to Jeff's point, it's a period of education to educate the consumers as to what we can offer and how they can interact with it. So if we all embrace that concept and that idea, then theoretically there is no reason why crypto cannot flourish going forward. So I think both are, the comments made by Toby and Jeff are interlinked. And I think that's one of the key points out of the recent past that we in the industry need to take away in terms of if we're going to make this a success going forward.
Yeah, the only thing you can really embrace in this market is change. If you choose to stop and think and look what's going on, everyone gets left behind. But I think that's just down to our market and in fact life. The only real constant in our market is change.
I just find it quite funny. This is the busiest winter I've ever had, and therefore,
Yes.
the only reason I think it's a winter, people keep telling me it's a winter. I've never been this busy.
Yeah, I agree.
So the idea is to dying off the edge of a cliff. I mean, no one told me, if you see what I mean.
I was not informed of this winter. Where was this memo?
It's been a busy period. James, love it or loathe it, KYC is not really so present in DeFi. If you go on Uniswap or a decentralized exchange, you're not having to go through the typical sort of onboarding process that you would see with a centralized exchange. Can you paint the picture as to why that is? Why is it that DeFi is so free of control and KYC, whereas if you go to a centralized exchange, you pretty much always have to do KYC?
Because lawyers don't have the world's greatest imagination, thanks to short answer. The reason we obsess over AML and KYC for crypto is at the time people thought it should be regulated, the EU was looking at upgrading the Fifth Money Laundering Directive. That's why it captured everyone's imagination. The rules around money laundering are based on an old-fashioned world whereby, if you come to me, I've seen money laundering, I see your passport, I see your utility bill, I look at that. If you don't want me to see that, then you are intrinsically a dodgy guy and I shouldn't act you. That's intrinsic assumption. We've seen since then things like a far greater awareness about stealing people's personal data, identity. These are all things that didn't exist when those rules were being put together in people's minds. So when you look at DeFi, what you've got an old world which assumes a certain type of relationship whereby why wouldn't you put out that data? Why wouldn't it work that way? And conversely, why would you rely on someone else to do it? And one of the biggest issues you've got in the regulated system at the moment is for KYC and AML. If you outsource that to a third party, you can't outsource responsibility. So nobody wants to do it because effectively they're still responsible for it. The biggest issue for DeFi at the moment is convincing the old world that there are ways of doing KYC and AML to a standard which is acceptable, and then convincing that this is the way to do it. And it's not as if money laundering doesn't exist in any other area. One of the funniest things I ever saw was one of the mainstream banks announcing they wouldn't touch crypto because it's all money laundering. And then the fine that they had for their own money laundering breaches in Mexico was greater than the entire size of crypto in and of itself.
Yeah.
Crypto is not a good place to do money laundering. You've got transparency, which is one bit unpixing the whole thing unpicks. Yes, the pseudonymity, but once that starts to fade a bit, so you go through an exchange, the whole thing falls apart. But you've got a perception, and a perception has been driven by various parts, and that's not helping. So DeFi has an intrinsic issue around KYC and AML because there is no intermediary. There's no guy like me sitting there saying, "Show me your passport." So you've got to look at other solutions, and that's both its biggest blessing, its biggest curse. Its biggest curse because you can't get people comfortable with it. Its biggest blessing because it's forcing the world to rethink, and we can't just copy and paste, which is the lawyer's answer to all new problems, to copy and paste on a bit of law and hope for the best. So it's about positioning, it's about getting people comfortable. And now's the time to do it because regulators are looking at how they're going to regulate this stuff. And at the moment, they're willing to talk. You give it 2 years' time, they'll have made up their mind. And whatever they've decided, you're lumped with, effectively. So this is the moment to have that conversation.
Just to build on that, Jason, I'd probably say that it's not necessarily that the messaging we need to put out there is that DeFi is anti or against KYC. It's just that we can do it a different way. And just to expand on that point from James, it really does come down to educating regulators about the fact what is the different way, and the different way is no less stringent necessarily than the traditional way. So I think that the messaging needs to be clear on the DeFi side of things, that we're not necessarily anti KYC, we're not trying to avoid it necessarily, etc. It's just that you can do it a different way to achieve the same aims. And remember that a lot of regulators are looking for outcomes. They're outcome-based regulators, certainly in the UK with the FCA. So you need to be able to demonstrate how your method and process achieves the outcome that the regulator, plurals, is seeking.
And the one I love is the £20 note. 80% of £20 notes have traces of cocaine on them. So if you've gone and bought your pet sandwich with a £20 note, you've probably handled the proceeds of crime, which is money laundering. And if they did a spectrum analysis, they would see traces of cocaine. For crypto, you can go all the way back to the Genesis block in Bitcoin. And if you argue the Genesis block was an act of treason because it's trying to create fiat currency in competition with sovereign currency, you can argue that every Bitcoin since then is the proceeds of crime. Everyone who's ever held a Bitcoin has handled the proceeds of crime. And therefore, everyone who's ever been in crypto is a terrorist. And therefore, we should lock up the entire crypto community. And I asked everyone for this, and shut the fuck up. That's not terribly helpful. So we don't do spectrum analysis of a £20 notes we can buy our pet sandwiches to see if they're proceeds of crime. Because we can go further in crypto, I think there's a huge distinction between what we can do, what we should do, and where our actual risk appetite lies. And just going, we should do everything doesn't make sense. And it's not what we do in the traditional world anyway. Otherwise, I'd never be able to buy a pet sandwich ever again.
Yeah, I'm glad you came out of the back of that story with a bit of positivity. That was a real mood killer if you just ended it there.
Well, I think it is a really interesting point, right? Like you pretty much, if you point sort of elliptic or whatever at one sort of almost any pool on Uniswap or SushiSwap or whatever, right? It will come back at 0.01% proceeds of crime. And this whole sort of list of things you really don't want to be involved with. And the mindset of like the DeFi technologist is, well, the information is key, and knowing that, and you should have a policy on board, and like this is an edge case, and you're probably doing better than Barclays and Lloyd's and whatever, right? And but then you try and deal with a fairly typical compliance officer and go, hey, well, this pool that I've been using only has 0.01% proceeds of crime in it. And I don't think most of these compliance people would be almost like the elliptic data you don't want to share outside of your kind of board level sort of analysis of the sector, right? So there's a very weird game of cat and mouse where you've got compliance world, which is 100% black and white, and everything is joined up, and then you've got sort of the real world and DeFi world where everyone sort of is papering over it in some way, and I don't know how you join them both up, really. Like,
it's then a risk-based approach. I mean, for every Bitcoin you take in, if it's under a threshold that's been designed in your KYC AML policy, that's also compliant with the regulator, you can only do as much as you can do. The way that everything in crypto is kind of linked together, and even more so now that we have DeFi bridges, there is going to be a level of exposure on nearly every transaction. Some of them are completely clean. They've never seen a single bit of tainting, as you want to call it. But with the details of everyone's bank account out there on chain, everyone is technically open to dusting attacks. I mean, take a look at any MetaMask wallet and go to other tokens. You'll have thousands and thousands of tokens that are more like, promotional, get you to go to a website kind of stuff. And as long as there's a risk-based approach on if the exposure is under X% or X dollar value, then it's fine, because some of these compliance regimes also look at wallet hops that are 2, 3, or 5 transactions deep, or 2, 3, or 5 relationships away. So any transaction that's ever touched, Huobi or Binance or Coinbase or any exchange is going to have a level of exposure to it. And I think it's just understanding the subject matter in order to properly address what the risk is. Oh, there's $4 of exposure on a $40 grand transfer. It's way under the threshold. We can live with that.
Gotcha. Now, moving on to regulation, Manoj, it's been just under a month since MiCA, the Marketing Crypto Assets Regulation, was ratified by EU Parliament. Can you give us a bit of an overview as to what MiCA is and why it's important for the crypto industry to be mindful of the changes to come with MiCA?
Sure. Giving an overview, MiCA is groundbreaking because it's effectively the first piece of uniformed regulation that gives an element of clarity on what you need to do in order to get a license to provide your service. Now, the reason why I think that is quite significant is because, and a couple of us have made the point about education and confidence in the use of crypto. Theoretically, the old school regulatory view is that licensing gives you that credibility because it builds consumer trust. So the theory is if you get your license under MiCA, that should help you bridge that confidence, that trust deficiency that may exist at the moment. Because obviously in the traditional finance world, all banks and third-party providers under PSD2, they're all licensed to give the consumer the confidence to utilize those services. So I think that's one of the main takeaways from MiCA is the fact that it's this licensing regime. And theoretically, if you get your license from a regulator in the EU, you have that element of credibility to hold up to traditional players in the ecosystem and or in the likes of banks, etc., who you might still need for certain services, but also to the consumer. In terms of obtaining your license, well, the detail of that is still not out necessarily, because a lot of this has been delegated. We're waiting for the national competent authorities in each of the member states to actually issue their specifics on what's required. But at a high level, you're looking at providing details about your organizational structure, your outsourcing, your complaints handling, safeguarding, these kind of issues. Again, very similar to what's required in the traditional payment space. Obviously for credit institutions, it's a lot higher, the requirements, but for other providers like on the PSD2, it's very similar to that. So it's about showing how your organization is, in effect, a mature entity in this space to provide a traditional financial service.
And what sort of timelines are crypto firms looking with you to, for those that are looking to adopt MiCA, what might be the pain points of MiCA?
I think the timelines certainly are, and the pain point potentially is obviously for stablecoin issuers, they go first as such. So theoretically, early next year, I think it's April next year, stablecoin issuers will need to have their license in place. With other crypto exchange providers, or CASPs as they're known in MiCA, they'll have to have their license in place by, in theory, January 2025. I'm saying in theory because it all depends on when the final text, even though it's passed last week, it needs to be published in the European Journal, which should happen next month or so, and then all the timelines kick in. Now, the pain points is going to be, well, exactly what do I need to get my license? So we need that detail to be published, and we hope national competent authorities publish that pretty soon so that we all have time to get our ducks lined up in order to submit our applications. And what you don't want is the competent authorities basically publishing their requirements 6 months before January 2025, and then there to be a mad rush to submit applications, and we don't meet those deadlines. So you want competent authorities publishing with notice to give everyone time to get all their paperwork ready to submit in order for that. And other pinch points might be, for example, where MiCA sits with other regulatory regimes, such as, for example, compliance with AML requirements, because at the moment AML is a separate piece of law, and therefore in a lot of states, EU states, you need a separate registration for AML. Now, are they going to bring that all in as one, for example? So when you apply for your MiCA license, you automatically get the registration requirements to tick the box under AMLD5 as well? I hope so. Otherwise, you may still have to apply to one in the worst case scenario, one competent authority for your MiCA license and another one for your AML registration, which is not really going to be great for us in terms of getting your registrations. You want to make it as streamlined but as rigorous as possible. So you want it unified. So these are some of the pain points I think that we're going to encounter in the next weeks and months.
Gotcha. And
I think it's just worth bearing in mind, the UK rules are going to come in faster than the MiCA rules around financial promotions, which is why everyone is talking about MiCA, and I get MiCA is important, and it's not to be underestimated, if you see what I mean. But there's this little joker in the pack in the UK, which is the regulation of financial promotions. Those rules are coming out Q3 this year. You have 3 to 4 months to get ready. It'll be a criminal offence if you don't. And that's going to come in faster than MiCA, effectively, which is why I'm sort of obsessed with those at the moment, more than MiCA. Because to be blunt, my expectation of MiCA is it will get delayed, because these things always get delayed. Because getting 27 countries to organise is nice. My favourite was Spanish under MiFID, where they were, I think, 4 to 5 years behind their original promised deadline. So I am more twitched on the UK, which is not in any way to undermine MiCA in the slightest, because it'll be important. But not enough people are banging on about financial promotions, and I think it's going to be my tombstone at the moment. I banged on so much. So I'm just throwing it out there for people to be aware of.
You have travel rule, Lenny, at the same time as well.
Yeah.
Gotcha. And James, we've recently had the UK consultation on the future financial services regulatory regime for crypto assets. So the consultation period ended as of the end of last month. How might that proposed regime actually affect UK crypto firms in terms of AML and KYC? Does it actually affect them as of yet, or is it something just to be mindful of?
So I think this goes back to the point which was made earlier about KYC and AML became important because that's what we were twitched about at the time those EUs went through. The UK was part of the EU at the time. That's why we twitched about that. Actually, in some ways, it's the wrong tools for the job. People aren't banging on about how they were not properly KYC'd and this led to them losing lots of crypto. They're banging on about the fact that there were advertisements which were misleading. There were scams which went through. This is all conduct of business. It's a whole different set of law. And one of the issues you've seen with the UK is the FCA is a conduct of business type regulator at its heart. It doesn't just do KYC and AML. And one of the issues firms have had with the crypto registration is they're dealing with a regulator who wants to do a lot more than just look at their KYC and their AML, and that creates friction in the thing because they don't want to approve something which is bad for consumers just because it's got a natty little KYC policy. What is going to happen in the UK is you're going to get the right tools for the job for the regulator. Now, what the regulator does with that is the big debate at the moment. And this is where it's been quite interesting because as far as we've seen, the regulator's been quite open to having a conversation to try and get the right tools for the job, but it's got a chance to get either right or wrong. In terms of the nature of the rules, I mean, the thing that always causes me to cringe is when they go, is it just MiCA? It's not. Now, all regulators come from a similar starting point anyway, so principles from traditional securities type stuff is going to be naturally the starting point for all regulators worldwide because of the similarities between the two. But UK is not going to just follow the EU. It is going to do its own thing. There will be overlap. And one interesting thing, we're speaking to a Central Asian regulator, and their view was 80 to 90% of all regulations are going to be identical virtually in most jurisdictions, and 10 to 20% is going to be completely different. And that 10 to 20% is going to be the selling point. Because, and I think, Manager, something you mentioned actually before it's called, regulators at the moment are beginning to start to come in competition with each other as to being the best place to set up. And this is a development which started with the FCA sandbox, and it's become more and more of an important thing. It's quality of regulation. And in an industry like crypto, where you can move jurisdictions so fast. You know, most of the guys that call out conferences in, say, the US or Europe or places like that, the ability to move means that it's now a real thing, the idea of jurisdiction shopping. And the only way to stop that is by going after the advertisements, and that's the first thing the UK are going to go after towards the end of this year. The starting gun is here. If you can sell anyone in the world, they get that. But if you can't get access to our citizens, you're irrelevant, effectively. And that, to me, therefore, is the biggest issue moving forwards, is it's killing the business move around because your financial person have to work. And that is how crypto is going to be regulated. No matter how decentralized you are, no matter how you feel that you can sort of move from country to country, that's going to become the battleground.
Yeah, and you touched on the complexities, James, around navigating multiple different jurisdictions. When you're looking at most crypto businesses, they're not necessarily just focused on one jurisdiction, but they are spanning a whole host of different jurisdictions. And one of the misunderstandings that I've come across from time to time, just for the EU, is that if you satisfy the baseline EU requirements on, say, KYC, then you're going to be okay to operate in any single jurisdiction within the EU, and that's incorrect. I mean, each jurisdiction has their own interpretation on the EU's baseline requirements, but their local requirements often, or in some cases, will go well beyond what are those EU requirements. And by not observing those local jurisdictional requirements, you're going to come a cropper with regulators. So it's just something to bear in mind for the audience. But Jeff, of course, you're the CEO of an FCA registered crypto exchange. Do you see MiCA as a threat? Is it a headache, or is this actually something that you believe in the long term is going to be of benefit to the crypto industry?
To boil a long answer down short, I think the more focus that is given on it to make the market better will make the market better. And it depends. It's not going to be a one size fits all. They're not going to get it right first time. There's always going to be benefits and drawbacks and arbitrage between different places. But for the people sitting on this call, we've all been in this market long term. And I think anything over 5 years doing the same thing can be considered long term. So, I think within the next 2 years, completely gut feeling, unfounded, and James will prove me wrong. So I love being proved wrong. You have to ask the right questions to get the right answers. I think with maturity and professionalism and legitimacy in the market, they might move crypto in the UK to a fully authorized status, which has additional reporting, reg cap, all that kind of headache stuff, but it's good for the market. And I think the one thing we all wanted when we got started in this, and that it's, blockchain is an amazing tech. It can be used for anything. We're talking about the financial side of it with investing and payments and trading and DeFi and all that kind of fun, crazy, flashy stuff. But to do what the regulators' main edict is, the main goal is to make a safe and fair market for everybody. And it's going to take several iterations to do it. I think a layered approach would be better. Are you a payments company? Are you an exchange? Are you a wallet provider? Or are you a technology company? And have a layered approach to that regulation so everyone can participate, from startups and institutions. But I think whatever they're doing now will be good for some and bad for others. I think it's really good long term. I will still be in this industry and market in the next 5-10 years, whether I like it or not. And no, I think it can only be good over the longer period of time. Maybe not short term. Everyone sees it as hostile, more KYC, less this, less that. But, where I want to be, where I want the market to be, is just like the internet. We don't even know you're using the internet now. You fire up an app on your phone and then you realize, oh crap, I'm going to reception. Blockchain and crypto will be so underlying as a technology. 10 years from now, we won't even know we're using a blockchain. We won't even know we're using a tokenization. We'll take the stuff we're doing now, which is really grassroots and really tech, and not still the great user experience, etc. All of that stuff will be gone, and we'll be using this technology without even knowing it. And that's where I think the market will be in 10 years. And it takes this kind of pain and suffering right now to get there.
Gotcha. And Toby, most regulators appear to be skirting around DeFi and NFTs. They haven't been too prescriptive around those aspects of Web3 or blockchain industry, however you want to describe it. Should DeFi be regulated?
Well, I think at the end of the day, you're just by performing certain activities, you are regulated, right? So the thing that I think gets many people in DeFi and crypto is the sort of, there are many things that are clearly better and smoother functioning in DeFi world, and it sort of generally feels like you're sort of I think there was quite a famous case of all the DeFi firms going to Washington and trying to sort of woo the regulator, and then they sort of turned around and used all this information and effectively began going, hey, we're going to police you, Uniswap and whoever, right? And they were sort of trying to look, we want, this is how our market operates, and this is existing regulations dating back to the 18th, 19th century. Here's how they are, and I think the reality is a lot of the smart technologists building this stuff are not very clued into regulation, perhaps just because the reality is like we were talking about startup that I was building. That was built by two programmers who built a tool that already had several 100,000 users, right? Like, and that's happening across the market. You're getting, I don't know, users or MetaMask or these things have, but they're huge organizations, really, but often put together by three men in a backpack, if you know what I mean.
And a PDF presentation.
Yeah, and a PDF presentation, exactly. So the problem you end up is it's that classic move fast and break things of the technology industry. All of the programmers come from that kind of background where they only have a business if they have traction, and they only have traction if they're extremely lucky. And then they suddenly need to go and talk with people like James and Manoj and go, hey, I did all these things and now have a lot of money spewing out over here, and people seem to really like the product. And then there's this huge document, MiCA, that I'm willing to bet there are very few DeFi CEOs who actually read the whole of MiCA, if you know what I mean. So you, not that excuses anything, but I think you've got that lack of joining up. I think we're going to get, to Manoj's point, stable coins being the first one, I think will be a really interesting test case for that regulation, because I mean, probably everyone on this call remembers SVB collapsing, leading to a crisis of confidence in Circle, which was actually the most transparent of the stable coins. But it's 3% exposure or plus to SVB, maybe it was 10. And the market wasn't really clear because I think there was just a list of names as to what USDC's exposure to the collapse of a bank where some of its assets were stored. But the fact that you had what will be interesting is as these stable coins get their mechanisms more in the public view, they'll probably be more vulnerable to attacks as well, right? So you'll probably get another MiCA crisis in a way, as either Tether decides to opt out of MiCA or Circle, perhaps. I'd be very surprised if they did. And what ends up happening there? So it's going to be an interesting scenario, I think. But I think the participants of DeFi and the participants of crypto do want to deal with the regulators and figure out how they comply, but are often very small startups that have got big, and there's a very experimental nature to the whole crypto industry, and I think that's one of the reasons why it's been very, very effective, but also and attractive to people who don't necessarily trust the banking system or financial institutions as they currently stand. And it will be, I think we're going to go for another bumpy road, but it's probably worth remembering that some of the biggest collapses in the last year and a half have really been the US banking sector, right? Like by quite a long way, and dwarfing FTX or whatever, right? So.
Gotcha. Now, taking a trip over to the US. In August of last year, OFAC blacklisted Tornado Cash. So it's made it illegal for US citizens, residents, and companies to receive or send money through the service. Manoj, are we likely to see other DeFi platforms hit by US sanctions, or was this perhaps a one-off just to test the water?
Hard to say it's a one-off based on the way the US regulators are behaving at the moment, in terms of how they're approaching various things. Short answer is no, I don't think it's necessarily a one-off, because I think the US regulators, their approach to things is very different to everybody else at the moment. So you cannot discount that and dismiss that, therefore, that they won't do something similar. How will the rest of the world react and follow? Well, again, it comes back to, I think some regulators are taking the view that we are going to embrace a different form of regulation and different form of interaction with this technology and the technology providers. So we're going to be less adversarial. And so I think that is my inclination at the moment, is a different reaction, different response necessary to the way the US is approaching things.
I think there's one interesting side point to this, which is by doing what they've done, they've almost represented code can be a person in and of itself to some extent, because normally sanctions are against individuals or groups of individuals. And if it hadn't been a negative thing, i.e. sanctions, but a positive thing, say recognizing a DAO, that may have had quite a different response among the crypto community. But in terms of the mental gymnastics, they're not that far off a regulator, if you see what I mean. So I get all the reasons why people don't like what they did, but flip side, there is a counter argument here, which is it's the beginning of seeing these smart contracts as legal persons rather than human persons in and of themselves, and that's not necessarily all bad news in that sense.
Gotcha. And a hot topic right now with DeFi is the introduction of digital identities, or at least some platforms being built with a view to tokenizing identity and allowing individuals a certain amount of ownership of their identity and how it's actually used on chain. Toby, do you believe that this is something that's gonna take off for DeFi? Do you think that individuals are going to be able to attest to who they are on chain and access certain financial services on chain? Or do you think this is something which is going to be more of interest to regulated entities trying to pursue a Web3 vision? Do you think that, generally speaking, individuals will be happy using digital identity on chain?
So clearly, individuals are happy with digital identity in chain in a certain extent. Right? And you only need to look at the numbers around ENS, right? Like there's almost like an obsession of people collecting the ENS and other kind of domain names tagged to your wallet effectively, and then going sort of the wallet, like the way I guess it works for the crypto native typically is like the wallet is your identity, and I think that's also been a big driver in how people have been playing around with the NFT market and the various fungible tokens they're collecting and the DAOs, and I think you're getting the early waves of experimentation of what people's digital identity looks like just by how people are using their wallets to interact with certain communities and where that goes. I think it's very different in the head of where, say, the Bank of England may be thinking we go with CBDC land and kind of there's probably a very different way the crypto natives are putting together the digital identity and the I guess a centralized way of going, how can you comply? I think intuitively, I think these things will marry up, but I think it will look slightly different to both how the sort of, I guess, regulatory compliance framework wants it to be, and then what Vitalik and various experimenters on Ethereum or wherever, what they're trying to code for. And I think you'll get what works on in the sort of smart contract world and what works for reality. And I think it will be good as the systems begin to marry up, right? Like I get a lot of parking fines, right? Like I'd love to be able to just go down to my train station and park my car, have it know who I am. I mean, I think.
Oh, they know who you are.
What?
They already know who you are.
They already know who you are, exactly. Right? Like you can. So, but you can. Yeah. And to a degree, you don't want that totally joining up, and I think there's a sort of we could quite quickly get into a sort of deep state fear debate over the digital identity. But I think the reality is, I think a lot of digital natives are embracing digital identity. I think in response, well, related to the Tornado Cash element, a lot of people are using the ZK rollups and all of those kind of things to go, look, there's only a certain amount of information people need to know for certain activities. And I think that will be how you get, I suspect it will be around the area of zero knowledge and how that joins up, where you will get the kind of slightly out there, slightly futuristic contents of your Ethereum wallet and being your sort of bundled identity, and then what various state organizations or whatever need to know, and how that joins up on the crypto side, I think will be quite interesting, basically.
Gotcha.
Just on, sorry, Jason, just on that point that Toby was making, I would strongly encourage the audience to, if they're interested in this space, to have a look at the work that's currently underway in the UK, for example, looking at digital identity, because it's very much dominated by traditional finance players, the banks, etc., and looking at digital identity, how they could set this up, who would have control over it, who has the liability risk, all those kind of things. It'd be interesting to look at that and see how we feel on the crypto side of things in terms of the concept of digital identity in the traditional finance sense, and where the gaps are, where the symmetries are into potentially how we might want to embrace it and use it in the crypto space. So it is, this kind of work in the digital identity space is on the radar of the traditional finance establishment. Whether or not they're factoring in those of us on the crypto side of things is debatable, but that doesn't preclude those of us on the crypto side of the fence looking at that and trying to put forward our views as well in order to try and make sure that our interests are taken care of, so that we can also utilize it for the benefit of the broader trust issue with this space.
Gotcha. So we've left a few minutes just to answer any audience questions. I mean, if there are any other additional questions, do feel free to pop that in the platform. I've just seen Gary Nuttall. Hey there. How different are MiCA and EOSCO's crypto and digital asset market recommendations? So that's a relatively new development with EOSCO's recommendations. I'm not 100% sure if we've had sufficient time in order to compare and contrast the two. James or Manoj, have you yet come across or done a review of the recommendations? Would it be too early to say what might be the key differences between the two?
Probably a little early, but what I would probably say is, remember, like I said at the beginning, we don't know what the specific requirements are for things like the licensing and the ongoing reporting obligations are once you have your MiCA license. So I think you probably need to wait for all of that detail to come out from the individual regulators across the EU in order to then be able to do a proper compare and contrast between the two.
Gotcha. Okay. Too soon, Gary. You're always ahead of the curve a little bit, but thanks for the question. I can't see any other questions on the platform just now? So we have a couple of minutes left. So I mean, on my side, I mean, it's obviously been a very, very interesting discussion, and I think it's given a good insight as to how regulation is going to perhaps shape the direction of travel for the crypto industry. But still, it is relatively early in the day in terms of exactly understanding how it's going to impact crypto firms and individuals. But it's clear that crypto is beginning to mature, and we're seeing more and more larger organizations and banks really start to weigh in to the industry, and they are carving their way into this industry. But it's clear that regulation makes it a safer space for regulated entities to start taking part in Web3. So whether or not all of the crypto ecosystem will be regulated, or there's going to be strict control requirements in DeFi, it's too early to say. But at the same time, as of now, we're still living in a very, very exciting stage in the future of money and the future of the internet and the evolution of Web3. So thanks everyone for listening in, and thanks to all the panelists for all your views that you've shared. I think this has been great.